You've had a chance to look at some of the details of the spending plan. Your first take?
So while detail matters, and we're going to get a lot more, my first take is as follows. A, this is a shift from the demand to the supply in terms of enhancing economic growth. And that's a good thing. We need to enhance productivity. And this aims both at enhancing physical and human productivity. Second, since we need to pay for it, the focus on corporate taxes is in fact the most pro-growth. Had he focused on household taxes, that would have taken away from demand. And corporate taxes, let's be honest, a lot of that money has gone in terms of buybacks, so it shouldn't have a massive impact on growth. So I view this as a very pro-growth, pro-productivity policy evolution.
Mohamed, when it comes to investment, though, private sector investment, what did we see when we cut tax rates in the United States from 35 to 21? And what do you think we'll see on investment from 21 to 28?
We didn't see as much as we had hoped for, because it turned out that what was stopping investment wasn't tax rates. In fact, what we saw when this happened, when the cuts happened, is a lot more buybacks. So the money went back to shareholders, but didn't go into the real economy. John, it's really tricky because everybody complains about infrastructure, and infrastructure has been hampering productivity. We know that from the figures. So if a well-designed, and that's a really important phrase, a well-designed infrastructure program can enhance productivity, the private sector ends up net better off.
Mohamed, does this kind of public investment for you mentioned the supply side of the economic equation, does this kind of investment for you at least reduce some of the risk around the inflation story and a persistent rise of inflation for years to come?
It does over the long term, but there's going to be a mistiming. You've heard me say there's three elements to the inflation surge that we're going to get. One is base effects. That's not worrisome at all. Two is simply a short cyclical mistiming between demand and supply. Demand goes up much faster than supply in the short term. That is also reversible. But it's the third element. We're starting to see the cost-push side of it. We're starting to see input prices go up. We're starting to see companies complain about transportation and other things. That's the one to keep an eye on, because that's the one that can really disrupt the markets.